Hey everybody, welcome. My name is Matthew. Thank you so much for joining. We are continuing on here with our series on the United States national federal debt. It's in the press a lot these days, over $34 trillion in debt. Here we have, as of April 2024, $34.6 trillion of federal debt. And we have over 200 years of history here, over 230 years since the Constitution was implemented and the Articles of Confederation was ended and the Constitution of the new United States started in the early 1790s. So what we did in the first couple episodes, we talked about the debt itself, how it increases during war. We also looked at the deficit. Now, what's the deficit? That's just a trailing 12-month snapshot. That's the best way to define it. Of course, you could do trailing month, but trailing 12-month snapshot of the debt. And when there are big spikes like this, during war, during depressions, during times of crisis, this is how much the debt itself has increased during that period. So as we see here during World War II, you can have debt go up 86, 90%, almost 100%. You can also have it go down a little bit. These are surpluses, which it did a little bit here in the late 40s. But generally, you're going to be going up. You're going to be trending up, as you can see with the chart. When there is a deficit, the debt will increase. The debt is simply a lifetime accumulation of deficits, okay? We talked about tax receipts, all right? That's the other side of the equation. So with taxes here, expressed as a percentage of the federal debt over the trailing 12 months, this is what you're going to use, of course, to cover your spending, but eventually, hopefully, to pay down that debt if you ever do. Okay, so this is before the spend. This is the taxes that you take in each year. We can see here it can be as high as 60%, as it was post-Vietnam, or as low as 15%, where, unfortunately, that's where we are right now. Now, I want to show the third main component of debt, national debt in the United States, and the importance of it, and that is the interest rate. The interest rate, of course, is the cost of funding or the cost of borrowing. A lot of people, by the way, say that the interest rate is the cost of money. Absolutely, it's not the cost of money. That is the exchange rate, right, versus any other currency or commodity. The exchange rate is the cost of money. The interest rate is the cost of credit, or the cost of funding. I only have a continuous picture here since the Great Depression, and this is always an annualized feature. You're going to have to take a look at this book if you want more detail on the history of the interest rates in the United States, for the government, for railroads, for companies all around the world. It's a great book, a must-have if you're interested in financial history. What I can tell you about the 1800s basically is it was not as high as it was here in the early 1980s, about 15% for the federal government, 15%. Of course, it was much higher for corporations and even short-term funding. It went over 20%, Paul Volcker. This was a 2,000-year high in many respects of developed societies. But the interest rates were 5, 6, 7, 8, 9% here in the 1800s after the Revolutionary War, and they steadily fell till the end of the century. They were 5% or under. Of course, they were defined differently. There were different levels of maturity. Not as easy to get a effective or blended rate. Hopefully I will do that eventually, but unfortunately I only have about the last 100 years of interest rates for the federal government of the United States. Let's just take a very brief look here. So we see that it was about 7% during the peak of the Great Depression, also when Roosevelt and the Federal Reserve confiscated the United States' gold. Not many people turned it in, but nonetheless, it was about 6.3%. And by World War II, when a lot more money printing and borrowing actually occurred, it went down to 2%. 2% was the effective interest that the United States government had to pay on the debt. We see here an all-time generational millennial high of 15% for a very developed, sustainable United States government to pay on its debt. 15% by 1983, and then it slowly fell along with the Federal Reserve decreasing rates, Alan Greenspan, all the way through Ben Bernanke and the financial crisis. Actually bottomed out, it seems, somewhere around 2% again during COVID, and now it's creeping back up with the rest of interest rates. It's about 3.2%, trailing 12 months at the moment. 3.2% is the United States cost of funding. So this is less exciting to look at compared to, say, how much we can really increase the debt if we want, that is deficit spending. Even less exciting, let's say, than taxes, which can be and can have much more wild swings. Again, I'm not saying that taxes are inherently a good thing at all. I'm just saying they can have wilder swings. Taking a moment to remind you that this show is brought to you by Trezor, home of the original Bitcoin hardware wallet. For over 10 years now, Trezor means business in Bitcoin security and functionality. When using their wallet software Trezor Suite to connect to the Bitcoin network, you're automatically connected via Tor, protecting your identity and giving you full control of your coins in a fully open source manner, both on the software level and on the hardware level. So head on over to Trezor.io to grab your Trezor Safe 3 with a secure element, Model T with a touchscreen, or the original Trezor 1, as well as a ton of available accessories to back up your keys and keep your coins safe. This show is proud to be associated with Trezor, but this is how the actual cost of the debt looks. All right, this goes to nobody but the bankers. It goes to nobody but the investors of the debt. Now, it serves a purpose. Absolutely. The interest rate is important in evaluating projects to understand if you are sustainable as a creditor or not. It has a signal to the rest of the economy, whether it's important to develop for the long term or not. But as we know, the Federal Reserve, central banks around the world, they have really influenced this project over the last couple hundred years to where the interest rate is very monopolized. It is very, it's very manipulated. Okay, so let's just do a quick math here. What is 3% on $34.6 trillion? Well, it's almost $1 trillion. All right, it's actually over $1 trillion, isn't it? Let's do even quicker math. 1032, yeah. $1.1 trillion trailing 12 months. That's what the federal government is paying on the cost of its funding at the moment. What do they pay on the military? For example, the spending side of this equation, it's about $1 trillion, depending on how you measure it, $1 trillion. So the United States is now paying as much on its debt to investors, to bankers, to foreign governments who hold their bonds. In totality, $1.1 trillion or so, trailing 12 months, at the same level or more than the military. All right, so that could be a risk for security, national security. It's disconcerting. You don't necessarily see the wild swings again, but you do see, once you add it up in gross real terms, it's a huge number. Gross nominal terms, I should say. Let's just do the quick math. Let's say in 1983. So here we had our debt was only $1 trillion. All right, so it's $1.27 trillion dollars, and at a 14.7 interest rate, that's $186 billion in debt. 187 billion dollars in debt during these peak rates of 1983. Certainly very high, but as the interest rate fell and the debt rose, those payments would also fall roughly still, until you get to this point where you're really increasing the debt, and the increase of the debt is way more than the decrease in interest rates, and it just becomes a huge number. It might seem like not an important feature to deal with, that is the interest rate, but it is very influential across the rest of the economy. It's a signal across the rest of the economy about how much can or should be invested for the long term, and it's going up. All right, you see that along with the rest of, you can barely see it here, but remember, 2% during peak COVID times. It's now 3.2%. It's going up. So on a percentage basis and on a real nominal basis, the United States debt payments are going up, and it's something to pay attention to. Again, I just want to do broad overview of the different signals, the different metrics that we can look at, and then put them all together at the end here. This is what this series is about, to really sort of understand where we are in the history of the United States and its national debt. So that's what we're doing here. I only have showing the last 100 years of the interest payments, the effective interest payments to investors and debt holders of the United States. But this is what it is. A huge number, over $1 trillion in nominal terms, low historically at 3.2%, but going up. And as we know, other interest rates around the United States at the moment, prime, short-term, mid-term, long-term bonds are all above that level at this moment. So it seems that that number is going to go up. Even if you're the federal government, your cost of funding is going up at the moment. It is concerning, something to take a look at. So deficits, taxes, interest rate. The chart starts to get cluttered along with the debt itself, which is the light green shaded area. We're going to plow through it. We're going to continue to show you the different pieces of the puzzle, put them all together at the end with a couple signals that can help us wade through these different things. That's all for this video. Let me know what you think in the comments about the interest rate, the cost of funding for the United States federal debt at the moment, 3.2% on over $34.5 trillion. Thanks for watching.